What's up, good people? This is First Generational Wealth Building, where we focus on transforming our money mindset, our money habits, and our money beliefs. I'm Ashanze, aka Zay, and today's episode is all about investing during the recession. I've gotten a ton of questions about what people should do, how they can get started, what to look for. And so in this video, I'm going to answer those questions. I'm going to talk about what platforms you can use to get started. I'm going to talk about what to actually look for in an equity. So whether it's a stock, a mutual fund, an ETF, or index fund. We're going to talk a little bit about when to actually put the money into the market. And more importantly, I'm going to talk about the strategy that I'll actually be using while I'm investing during this recession. So if this is something you want to learn more about, you're definitely going to want to stay tuned. In the meantime, I need you guys to like this video as well as press that little red button to subscribe to my channel so we can get this to other first generational wealth builders as well. Now, without further ado, let's get into the video. So first, let's start with the brokerage firms or platforms that you can use to get started investing. I've got a ton of questions about, where do I go to get started? And so I'm going to start with the traditional route. So there's three companies that I recommend. So those are going to be the three that I talk about. And those are Vanguard, Charles Schwab, or Fidelity. These are all traditional brokerage firms where you can open a normal investing account and get started investing. Now, these are traditional brokerage firms, so the actual interface or like the user platform for beginners, it may not be as user friendly as like some of these apps out here. So a lot of people will get intimidated by that, but I'm here to tell you that it's not that challenging. So number one, in order to even open up an account with one of these brokerage firms, it's fairly simple. You just go to the website, you can do it online. I believe all three of them don't require a minimum to get started. The only minimum would be depending on, what equity you're looking to buy. So it's fairly easy to get started. As again, you go online, you sign up, you have to enter all your information. Once you do that, eventually you'll have to link your normal bank account so you can do the transfer and get money into the account to start buying stocks. And after that, that's pretty much it. Now, I personally recommend the traditional brokerage firms because when it comes to picking different equities, a lot of these have a lot of options. They have a lot more information on there, as well as, with the recent outages experienced by companies like Robinhood. I just think these are safer. It's a safer way to go. That's not to say that the fintech apps or the other apps that I'm going to talk about in a second are bad or not good. I just believe in, tried and true. So that's why I'm, opening my account with Vanguard and will be investing through Vanguard. Another thing about the traditional brokerage firms is that they also are now offering no fees when it comes to trading. So that was like the thing for these fintech apps, is that they weren't charging commissions for trades and stuff. And so now that they've had this fee war, a lot of these traditional companies aren't charging fees as well. So to get into the actual fintech apps, so when I say fintech apps, I'm talking about things like Robinhood, M1 Finance, and Ellevest, Betterment, any type of financial platform that's an app that allows you to invest through it. So those are also other platforms that you can use to get started. Out of the ones I just named, of course, I would recommend Robinhood or M1 Finance, but I do want to put a disclaimer out there that, as you can see from the recent outages, there is some risk when you use these type of platforms. And I'm not saying risk as in you could lose your money or anything like that, but they experienced outages, and so people couldn't trade or couldn't sell, and so that did lead to a little bit of losses. I will say that these fintech apps or apps like Robinhood and M1 Finance, they have more friendlier interfaces, or the apps are much more user friendly. So they make it a lot easier for you to process trades, to buy trades, et cetera, right? And so that's why a lot of people go with them. The thing that I would say to look out for with these type of fintech apps are the fees. So that's another reason why I recommend going the traditional route over these apps is because with traditional brokerage firms, and depending on what you invest in, the fees are a little bit lower versus these fintech apps. Typically they're charging anywhere from a couple dollars, maybe 1, 2, 3%, depending on what you're investing. With these apps, they're going to charge you that, whether it's a monthly or yearly fee. And so over the long run, this stuff can compound and cost you a little bit of money. So that's pretty much, the platforms you can use to get started, whether you want to go the traditional route or the fintech route. There's a lot of options, and there's a lot of good options, and I just named a few. So go ahead and take advantage of whether you want to go the traditional route or use the fintech apps. In this video or in the description down below, again, I'll drop links as far as to the different firms as well as the fintech apps that you can use or download to get started. So that answers the first question. How do I get started? Those are the platforms or brokerage firms that I recommend and that you can use to get started to invest during this recession. So that brings me to my second point, which is what to look for when picking an equity. Now, let me define what an equity is. An equity is where you have ownership of something of value, right? Now, there's all different types of equities within the stock market. As I mentioned, you have a stock, you have index funds, you have mutual funds, and you have ETFs. There's a few others, but for now, these are going to be what I focus on because this is what most people have been asking about or trying to acquire. So let me even break down each of those different equities so you understand the difference between them. So a stock, right? That is a individual share that gives you ownership within a specific company. So if you buy a share of Apple or Google or Microsoft, you now own a tiny fraction of this company. And as the company grows and the share price grows, you make money, right? So then you have what's called an index fund, right? Now, an index fund is a collection of stocks or bonds that typically tracks a index. So an index would be like the S&P 500 or the Dow Jones or the Russell 1000. Like these are all indexes that are comprised of like the top 500 companies or 1,000 companies on the stock market or international markets. And basically these index funds try to mirror what those indexes do. Now, they are typically passively managed, so the fees are less, which is why a lot of people recommend index funds because you basically are tracking the market and the fees are a lot less. So over time, you're just going to make a lot of money, right? That leads me into the next thing, which is like the cousin of index funds, which is mutual funds. Now, the only difference between a mutual fund and an index fund is that with mutual funds, you usually have a fund manager who is actively managing that fund, meaning he's trading stocks in and out and he's trying to beat the market. Whereas an index fund is just trying to pace or track the market. Now, with a mutual fund, that does come with higher fees because, again, you have somebody actively managing your money and trying to make you more money. So they come with a little bit more fees. Now, of course, through my studies and just learning, I always, recommend index funds over mutual funds because of the fees. But there's nothing wrong with mutual funds. I think, a lot of people, when they hear that, they say, well, why would I go with a mutual fund? Well, some people do want to try to beat the market. And so if that's the case and you don't mind paying that extra fee, then you will want to go with a mutual fund, right? And then the last thing, right, is an ETF. Now, an ETF is an exchange traded fund, and it's just like a mutual fund, except that they trade like a stock. So it's still a collection of stocks or bonds that are, pooled together. But the only difference is that they trade and have price daily fluctuations just like stocks, whereas mutual fund and index funds, they typically settle at the end of the day and the price only change at the end of the day once it gets updated. So those are the 4 equities that you can choose from, and I define them for you. So the next question is like, what do I look for when trying to choose one? So that really does depend on your investing strategy. Prime example, right? So I'm going to use myself and in our 401k and index funds, in our IRAs, we mainly invest in index funds because we know that's a long-term investing vehicle, and we don't want to be too too aggressive. We want to be a little bit conservative. We're not looking to have a big boom within it, so we are okay with just picking index funds that track the total stock market and letting that grow over the long term, because we can't touch that money for 30-40 years anyway. Now, if you have a traditional brokerage account and maybe you're trying to use that money for growth, or maybe you just want to pick a few stocks to grow your money in a 5 to 10 year period to do other ventures, you can do that as well. So I think when it comes to what to look for when picking a certain equity, it depends on what your investing goals are. I would also add that it does depend on your risk tolerance, right? So I mentioned that in our 401k or IRAs, we don't want to be overly aggressive. So we pick funds that are fairly conservative in that we're not picking a lot of risky companies. So we're picking like the US large cap growth index fund or something like that, meaning like where the fund that we're picking is comprised of like the top 100 companies in the US, and with their balance sheets and name brands, they're going to be around a long time, whereas they got stuff that you can pick from up and coming companies, but that's more risky because you don't know if that company is going to stay around for the long term. One other thing that I do want to add when it comes to picking an equity is also consider like household brands or companies that you use every day. This is probably the best tip that I give, is look in your house and look at the products you use the most. If you have an iPhone and a Mac, you're going to want to maybe buy Apple, or maybe you have you are a big Microsoft user, so you want to buy Microsoft. If you love shopping at Walmart, maybe you want to buy Walmart. Think about those brands and everyday consumer goods that you use a lot, and that also can help you figure out what stocks or what consumer sectors to look at. So let me add that in, right? So if you want to go the index fund route, you can do like, you have large cap, mid cap, small cap, you have growth, value, dividend. You can also do sector specific index funds or ETFs, meaning that they track a specific industry, whether it be technology, consumer goods, real estate, energy. All of those sectors have their own ETFs or index funds. And if you feel passionate about a specific industry or sector, you can invest in an index fund that is comprised of those type of companies. So to give you an example, if you got a technology ETF, it will be consumed of like Apple, Microsoft, Intel, Cisco, like all of the top technology companies are going to be within this one fund. So you wouldn't find a company like Home Depot within a technology index fund, because Home Depot is not a technology company, right? So those are some things to consider when it comes to how to pick or choose an equity for your portfolio. So hopefully those tips and things to consider help you out when you're deciding on which route or which equity you want to pick. Okay, so that brings me to the third question that I've been getting, which is, when do I actually put my money into the market? And I'm gonna leave you with this saying that I've come to learn, which is time in the market is better than timing the market. So what I mean by that is, if you are a long-term investor, any time is a good time to invest, because you're not going to need that money for 20 to 30 years. And historically, the market has always gone up. So if you're a long-term investor, any time is a good time to invest. So what I recommend is, don't try to time the market. Come up with a plan where you are investing on a consistent schedule, whether it be monthly, bi-weekly, every 2 months, whatever that schedule is for you. That's how you want to invest. You want to come up with a consistent schedule with a consistent amount that you're always going to be putting into the market, versus saying, oh, I'm gonna try to time the bottom, I'm gonna put in this much. It's just going to cause a lot of confusion, especially if you're new to investing and you really know what you're doing. You don't know what you're doing. That is not what you want to do, because eventually you're going to lose money, and then you're going to be like, I hate the stock market, I knew it was a scam, and blah blah blah, all the things that people say when they go into it blinded. So when it comes to when to put money into the market, again, it really does depend on what your strategy is, what your plan is. But again, if you are a long-term investor, any time is a good time. And that actually leads me to the fourth point that I wanted to make in this video, is the strategy I'm actually going to be using, because I think when you hear my strategy, it will help you understand how you can go about putting money into the market. So point number 4, the strategy I plan to use during this recession and when I'm investing is I'm going to be using the dollar cost average strategy. So the dollar cost average strategy means that I'm basically going to be investing the same amount, but on a time schedule, regardless of if the market is up or down, right? So let's say I choose to invest today. I put $1,000 into the market in one specific stock, and the price is, say, $200, right? So I get 20 shares. Let's say next week it goes down a little bit. I'm going to still put that same $1,000 and buy that same stock, but now I'm getting more shares, right? And so if you do that consistently over time, you're going to end up with a certain amount of shares, and you're going to have an average cost of what you paid for that stock. Now, there's going to be times when you paid more, there's going to be times when you paid less, but again, it's going to average out, and that's going to be what's called your cost basis. And if you go into investing with that kind of strategy, it usually works out well for you. So again, that's what I plan on doing. And just to elaborate some more, the plan will be to buy, specific index funds, because that's what I'm a big fan of. I may buy a few stocks as well that I've been eyeing, definitely some blue chip and value stocks. I do have a goal of how many shares I want. So that's another tip that I would say. Set a number of shares you want to acquire. So say you want to acquire 100 shares of Facebook. Well, one week you'll buy 25 at a specific price. The next week you'll buy another 25 at whatever price it is. That, the third week or the next month you buy another 25 at whatever price it is. And then the last buy, you buy another 25. So now you've bought 100 total shares, but you bought them at four different time frames at 4 different prices. And so you're going to then average all of that out, and that's going to be your average cost basis. And from that point forward, okay, if your average is $100, anything over $100, you are making money. And if it goes below, you're down. So, that's basically what the dollar cost averaging strategy looks like. And again, that's what I'm going to be using and employing during this so-called, this recession that I believe we are going into. Now, another thing I want to add is that because it is going to be a recession, I do believe, prices will continue to go down. And so that's scary, right? You're like, I'm investing and I don't want to lose money. But what you have to understand is you're not really losing money because you haven't sold. If anything, you're going to be acquiring more and more and more shares as the price goes down, down, down. And then eventually when the market rebounds, you're going to make all that money back. Every ladder or every level you bought at, eventually once that gets past that, you're now, banking in, banking. And especially over the long run, think about it. If you're getting these prices down at 30% discount, in order for you to, let's say you bought it originally and you lost 30%. Well, in order for you to get that 30% back, the price actually has to go up like 60%, in order for you to make that, just for you to get back even, right? And so if you've been ladder buying, every time you hit one of those ladders, the price, you're going to be making more money. And so, the dollar cost average strategy is that's what I'm going to be employing. There's other strategies out there, but I'm just going to focus on the one that I'm doing because I think that is what new investors or anybody new to the investing game should be looking at. It's a tried and true method. And so that is, what I'll be doing. And if anybody's watching this video, I think that's a good strategy for you to employ. Okay, guys. So, I've answered the questions that have been asked of me. I just want to say investing during a recession can be scary. And it also comes with some risks. Again, don't try to time the bottom because who knows, how low these prices are going to go. And that's why, as I mentioned earlier, employing a strategy such as dollar cost averaging is going to be the best, because you'll continue to get, the lower prices, and eventually once it starts going back up, you'll remember, hey, I remember a couple weeks ago I bought at this price level and now it's coming back up, and maybe you buy some more at that price level again, or maybe now you're riding the wave all the way back up. So, just a quick recap. We've talked about the platforms that you can get started on. We talked about, what to look for in the different equities and what the different equities are. We talked a little bit about, when to actually put money into the market. And lastly, I shared the strategy that I'll be using during this recession. And so I ended with, guys, please do your due diligence. Take this time to really improve your financial IQ, learn what investing is all about. I have so much more content coming. We'll get into risk tolerance, asset allocation, because all of these things will help you put together the proper plan. But in the meantime, I do want to give you this information so you can get started. So if you like this video, please press that like button, as well as don't forget to press that subscribe button to subscribe to my channel. And in the meantime, until I catch you guys in the next video, y'all know the phrase, stay blessed and peace out.